Imagine turning $1,000 into $28,000 in just 13 years. Not for Peter Lynch. He achieved this managing the Fidelity Magellan Fund. From 1977 to 1990, Lynch transformed Magellan into a Wall Street titan. Using common sense and a keen eye for opportunity, he believed anyone could succeed in the stock market. Invest in what you know. Identify companies you understand and use every day. Lynch's success was about long-term investing. Ignore the short-term noise, stay true to your strategy. Peter Lynch's journey to becoming a Wall Street legend is an inspiring tale of hard work, determination, and a bit of luck. Born in 1944, Lynch developed an early interest in the stock market thanks in part to his summer job as a golf caddy. He overheard conversations about stocks and investments while caddying for executives at a local country club. This early exposure sparked a lifelong fascination with the market. Determined to pursue his passion, Lynch attended Boston College, where he majored in history, philosophy, and psychology, an unconventional but ultimately valuable foundation for his future career. He believed that understanding people and their behavior was just as important as understanding financial statements. In 1966, Lynch landed a summer internship at Fidelity Investments, a small mutual fund company at the time. This wasn't a glamorous Wall Street gig. Lynch was tasked with researching the textile and metals industries. However, he approached this opportunity with the same diligence and enthusiasm that would later define his career. His hard work and insightful analysis caught the attention of Fidelity's founder, Edward Johnson II. So impressed was Johnson with Lynch's work ethic and investment acumen that he hired him full-time after graduation. This chance encounter with Johnson would prove to be a pivotal moment in Lynch's life, setting him on the path to becoming one of the greatest investors of all time. Peter Lynch's investment philosophy was revolutionary in its simplicity. He believed that the stock market was not some mysterious entity accessible only to Wall Street insiders. Instead, he argued that anyone could understand the market and make informed investment decisions. He challenged the prevailing notion that investing was a high-stakes game of speculation, best left to the experts. Lynch's approach was grounded in common sense and a deep understanding of businesses. He believed that the best investments were often right under our noses, in the products and services we used every day. He encouraged investors to look beyond the complex jargon and intimidating numbers of Wall Street and focus on what truly mattered, understanding the businesses behind the stocks. He famously said, "Never invest in any idea you can't illustrate with a crayon." This simple statement encapsulated his belief that investing should be accessible to everyone, regardless of their financial background. He urged investors to focus on companies they could easily understand, companies whose products or services they used and whose business models were clear and straightforward. Lynch's approach was a breath of fresh air in the often confusing world of finance. He demystified the stock market, making it accessible to the average person. He showed us that investing wasn't about predicting the future or chasing the latest hot stock tip. It was about understanding businesses, identifying opportunities, and investing for the long term. Peter Lynch believed that truly understanding a company went beyond simply analyzing financial statements. While numbers were important, he argued that they only told part of the story. He emphasized the importance of qualitative factors such as the quality of management, the company's competitive advantage, and its long-term growth prospects. He encouraged investors to become amateur sleuths, to look beyond the numbers and dig deeper into the companies they were considering investing in. He believed that by understanding the nuances of a business, investors could gain an edge in the market. He urged investors to visit stores, talk to customers, and even try out products themselves. Lynch was famous for his buy what you know philosophy. He believed that investors were more likely to make informed decisions about companies they understood and whose products or services they used regularly. He argued that this familiarity gave investors a valuable advantage, allowing them to spot trends and opportunities that others might miss. He emphasized the importance of investing in companies with a strong track record of growth and profitability. He looked for companies that were well-managed, had a competitive edge in their industry, and were positioned to benefit from long-term trends. He believed that these companies were more likely to deliver consistent returns over time. Section 5. The power of simple investing. Peter Lynch's investment strategy was refreshingly straightforward. He believed that you didn't need a PhD in finance or access to insider information to succeed in the market. He championed the idea that anyone, armed with common sense and a willingness to learn, could become a successful investor. He advocated for a simple, disciplined approach, focused on identifying undervalued companies with strong growth potential. He encouraged investors to ignore the noise and hype of Wall Street and instead focus on the fundamentals of the businesses they were considering investing in. He believed that by understanding the key drivers of a company's success, investors could make more informed decisions about its long-term prospects. He stressed the importance of patience and discipline. Lynch understood that the market would inevitably experience periods of volatility, but he urged investors to stay the course and avoid making rash decisions based on short-term market fluctuations. He believed that by sticking to a well-defined investment plan, investors could weather the storms and come out ahead in the long run. He was a strong advocate for diversification. He believed that by spreading their investments across a variety of industries and sectors, investors could reduce their overall risk and improve their chances of achieving their financial goals. He encouraged investors to build a diversified portfolio of stocks that met their individual investment criteria and risk tolerance. The power of 10-baggers. Peter Lynch sought extraordinary opportunities, turning modest investments into small fortunes. He coined the term 10-bagger for stocks increasing tenfold. Lynch believed 10-baggers were more common than people thought. The key was identifying companies with exceptional growth potential. Often these were businesses in overlooked industries. Lynch believed hidden gems were right under our noses. Focus on companies with strong fundamentals and a compelling growth story. 10-baggers can supercharge your portfolio's growth. Finding a few winners could significantly boost your returns. Section 2. Unveiling the 6 stock categories. Peter Lynch categorized stocks into 6 groups to simplify investing. Understanding these categories helps investors make informed decisions. Each category has unique characteristics, risks, and rewards. Slow growers are mature companies with steady growth. Stalwarts are large, stable companies with consistent earnings. Fast growers experience rapid growth in emerging industries. Cyclical's performance depends on economic cycles. Turnarounds have potential for recovery. Asset plays have undervalued assets. Understanding these categories helps build a diversified portfolio. Lynch's system simplifies navigating the stock market. Section 3. Slow growers, steady but unremarkable. Slow growers, as their name suggests, are companies that plod along at a steady but unhurried pace. They are often well-established businesses with a long history of profitability, but with limited growth prospects. These companies typically operate in mature industries with intense competition and few opportunities for significant expansion. Think of utility companies, consumer staples providers, or large established retailers. While slow growers might not get your pulse racing with excitement, they do serve a purpose in a diversified portfolio. They offer stability and predictability, often paying consistent dividends that can provide a steady stream of income for investors. These dividends can be particularly attractive to retirees or those seeking current income from their investments. However, investors shouldn't expect significant capital appreciation from slow growers. Their slow growth rates mean that their stock prices are unlikely to skyrocket, and their returns will likely lag behind those of faster-growing companies. Investing in slow growers is more about playing defense than going on offense, providing a cushion against losses in other parts of your portfolio. When evaluating slow growers, it's essential to look for companies with strong balance sheets, low debt levels, and a history of paying consistent dividends. These factors indicate financial stability and a commitment to returning value to shareholders. While slow growers might not be the most exciting investments, they can provide a valuable foundation for a well-rounded portfolio, offering stability, income, and a degree of protection against market volatility. Section 1. Stalwarts, the steady eddies of your portfolio. Stalwarts, in the Peter Lynch lexicon, are like the reliable, steady-going workhorses of the stock market. Think of those big blue-chip companies you know and likely interact with daily. They are often household names, leaders in their respective industries, with a proven track record of profitability and a history of weathering economic storms. These aren't the companies that will double your money overnight, but they offer something equally valuable: stability and consistent growth. Stalwarts typically grow at a moderate pace, often in line with the overall economy. They might not be flashy, but they generate consistent earnings, pay dividends, and reinvest in their businesses, providing a solid foundation for long-term growth. Think of companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble. These companies have been around for decades, delivering consistent products and services that people rely on, regardless of the economic climate. They might not experience the explosive growth of a tech startup, but their stability and consistent performance make them attractive investments for those seeking to build wealth gradually and steadily. When evaluating Stalwarts, it's crucial to look for companies with strong competitive advantages such as brand recognition, economies of scale, or a loyal customer base. These factors provide a buffer against competition and allow these companies to maintain their market position and profitability over time. Stalwarts might not be the most exciting investments, but their stability and consistent growth make them a valuable addition to any diversified portfolio. Section 2. Fast growers riding the wave of high growth. Fast growers are the sprinters of the stock market, companies that are experiencing rapid revenue and earnings growth. These companies are often found in emerging industries or are disrupting established ones with innovative products or services. They are the companies that capture headlines, attract investor excitement, and have the potential to generate outsized returns. However, investing in fast growers comes with its own set of risks. Their rapid growth is often accompanied by high volatility, as their stock prices can fluctuate wildly based on market sentiment and investor expectations. These companies are often unprofitable in their early stages, investing heavily in research and development or marketing to gain market share. Think of companies like Amazon in its early days, Tesla, or Netflix. These companies experienced explosive growth as they capitalized on new technologies and consumer trends. They disrupted established industries, challenged conventional wisdom, and rewarded early investors handsomely. However, their paths were not without bumps, as their stock prices experienced significant volatility along the way. When evaluating fast growers, it's essential to look for companies with a clear vision, a sustainable competitive advantage, and a large addressable market. These factors suggest that their rapid growth is not a fleeting moment, but rather the beginning of a long-term trend. Investing in fast growers can be lucrative, but it requires a strong stomach for volatility and a belief in the company's long-term potential. Cyclicals are the roller coaster riders of the stock market. These companies thrive in booms and struggle in busts. Timing is crucial. Buy low, sell high. Think Ford, Boeing, Caterpillar, high risk, high reward, requiring careful analysis. Section 4. Turnarounds, finding diamonds in the rough. Turnarounds are the comeback kids of the stock market, companies that have fallen on hard times but are showing signs of life. For those willing to do their homework, turnarounds can offer significant upside potential. Investing in turnarounds is not for the faint of heart. Think of companies like Apple, General Motors, or Netflix. They faced significant challenges but emerged stronger. It's a high-risk, high-reward proposition, but it can be lucrative. Section 5. Asset plays, unlocking hidden value. Asset plays are like treasure hunts in the stock market, companies sitting on valuable assets not fully reflected in their stock price. These assets might be tangible, like real estate, natural resources, or patents. The market often overlooks these assets, creating opportunities for savvy investors. Investing in asset plays requires a keen eye for value and a willingness to dig deeper. It's not always obvious what assets a company possesses or their worth. It requires research, analysis, and a bit of detective work to uncover these hidden gems. Section 6. The Art of Stock Picking, Research and Due Diligence. Peter Lynch firmly believed that successful stock picking wasn't about luck or insider information. It was about putting in the time and effort to research and understand the companies you were considering investing in. He advocated for a hands-on approach, encouraging investors to become amateur sleuths, gathering information from various sources to form a well-informed investment thesis. He urged investors to start with what they knew, looking for investment ideas in their everyday lives. What products and services did they use and enjoy? What companies were doing well in their local communities? By starting with their own experiences and observations, investors could identify potential investment opportunities that others might overlook. Once they had identified potential investment ideas, Lynch stressed the importance of digging deeper, going beyond the headlines and the hype to understand the fundamentals of the business. He recommended reading company annual reports, industry publications, and analyst reports to gain a comprehensive understanding of the company's financial health, competitive landscape, and growth prospects. Lynch believed that the best investors were lifelong learners, constantly seeking out new information and refining their understanding of the market. He encouraged investors to attend industry conferences, talk to company management, and visit company stores or facilities to gain first-hand insights into the businesses they were considering investing in. For Lynch, knowledge was power, and the more you knew about a company, the better equipped you were to make informed investment decisions. Section 7. Knowing when to buy. Spotting opportunities. Timing, as they say, is everything in the stock market, and knowing when to buy is just as important as knowing what to buy. Peter Lynch believed that the best buying opportunities often arose when fear and pessimism gripped the market, creating a disconnect between a company's stock price and its intrinsic value. He encouraged investors to be contrarian, to look for opportunities where others were selling out of fear or uncertainty. He believed that market downturns and periods of volatility presented some of the best buying opportunities for long-term investors, allowing them to purchase shares of great companies at discounted prices. Lynch also stressed the importance of patience, recognizing that the best investments often took time to play out. He urged investors to resist the temptation to chase short-term gains or to panic sell during market fluctuations. He believed that by maintaining a long-term perspective and focusing on the fundamentals of the businesses they owned, investors could ride out the market's ups and downs and emerge from periods of volatility even stronger. He encouraged investors to look for catalysts that could propel a company's stock price higher, such as new product launches, earnings surprises, or industry tailwinds. By identifying these potential catalysts, investors could position themselves to benefit from positive developments that the market might not yet fully appreciate. For Lynch, the key to successful investing was not about predicting the market, but about identifying and capitalizing on opportunities as they arose. Section 8. Knowing when to sell. Taking profits and cutting losses. Knowing when to sell is arguably even more challenging than knowing when to buy. It requires discipline, objectivity, and a willingness to deviate from the herd mentality. Peter Lynch believed investors should have clear selling criteria to avoid emotional decisions. Sell when the company's story has played out and it has achieved anticipated growth. Holding too long can lead to missed opportunities to redeploy capital. Lynch stressed cutting losses and moving on to other opportunities. Holding on to losing stocks in hope of a rebound is a recipe for disaster. Reevaluate holdings periodically to ensure the investment thesis remains intact. Selling is a natural part of investing, allowing for profit locking and capital reallocation. Section 9. The 2-minute drill, quickly assessing a company. Peter Lynch understood that not everyone had the time or inclination to pore over financial statements and conduct in-depth company research. That's why he developed a simple yet effective framework for quickly assessing a company's investment potential, a framework he called the 2-minute drill. The 2-minute drill involved asking yourself a series of straightforward questions about a company, questions that could be answered in 2 minutes or less. These questions were designed to cut through the noise and focus on the most critical factors that determined a company's long-term success. Some of the key questions in the 2-minute drill included: what does this company do? Can I explain it to a 10-year-old? What are the company's key products or services? Who are its main competitors? What is the company's competitive advantage? What are its growth prospects? Is the company financially healthy? Is the stock price attractive? By answering these questions honestly and objectively, investors could get a quick read on a company's investment potential, identifying red flags and highlighting areas that required further research. The 2-minute drill wasn't meant to be a substitute for thorough due diligence, but it provided a valuable starting point for evaluating investment opportunities and separating the wheat from the chaff. Don't be fooled by cheap stocks. Avoid value traps. Stocks that seem cheap but have hidden problems. These companies might have declining sales or mounting debt. Don't be seduced by low prices alone. Understand why a stock is cheap before investing. Look for signs of trouble like shrinking margins or management missteps. Invest in companies with a sound business model and sustainable advantage. These companies are more likely to deliver long-term value. Section 11. The importance of patience and long-term thinking. Peter Lynch was a staunch advocate for patience and long-term thinking in the stock market, believing that the best investments were often those that played out over years, not months or weeks. He understood that the market could be irrational in the short term, driven by fear, greed, and speculation. But he believed that over the long term, fundamentals would prevail, and the best companies would be rewarded. He encouraged investors to ignore the noise and hype of Wall Street, tuning out the constant barrage of news headlines, analyst predictions, and market commentary that often led to emotional decision-making. He believed that by focusing on the fundamentals of the businesses they owned, investors could block out the noise and make more rational investment decisions. Lynch stressed the importance of staying the course, riding out the market's inevitable ups and downs, and resisting the temptation to panic sell during periods of volatility. He believed that by maintaining a long-term perspective and sticking to a well-defined investment strategy, investors could weather the storms and emerge from market downturns even stronger. He encouraged investors to view their investments as ownership stakes in businesses, not just pieces of paper to be traded. He believed that by understanding the businesses they owned, investors could make more informed decisions about when to buy, hold, or sell, and they would be less likely to be swayed by short-term market fluctuations. For Lynch, patience and long-term thinking were not just virtues. They were essential ingredients for investment success. Ignore the hype and focus on fundamentals. In the age of 24/7 financial news, it's easy to get caught up in the hype. Peter Lynch urged investors to tune out the noise and focus on long-term value. He cautioned against blindly following the herd. Lynch believed the best investors were independent thinkers. He stressed the importance of sticking to your investment plan. Focus on long-term fundamentals to achieve financial goals. Section 13. Managing risk through diversification. Peter Lynch, despite his remarkable track record of picking winning stocks, was a firm believer in the importance of diversification. He understood that even the most skilled investors made mistakes, and that no one could predict the future with absolute certainty. Diversification, he believed, was the best way to mitigate risk and protect your portfolio from unforeseen events. He advocated for spreading your investments across a variety of industries, sectors, and asset classes, ensuring that no single investment had the power to make or break your portfolio. He believed that by diversifying your holdings, you could reduce the impact of any single stock's poor performance and increase your chances of achieving consistent returns over time. Lynch also stressed the importance of diversification within asset classes. For example, he recommended owning stocks in both large, established companies and smaller, faster-growing companies, balancing stability with growth potential. He encouraged investors to consider international stocks as well, expanding their investment universe beyond their home countries and tapping into growth opportunities in different parts of the world. He believed that diversification wasn't just about reducing risk, it was also about capturing a broader range of market opportunities. By owning a diversified portfolio, investors could participate in the growth of different sectors and industries, ensuring that they didn't miss out on potential winners. For Lynch, diversification was a cornerstone of sound investment management, a way to protect your capital, reduce volatility, and increase your chances of achieving your long-term financial goals. Section 14. Taking control of your financial destiny. Peter Lynch's investment philosophy transcended the realm of stocks and bonds. It was about empowering individuals to take control of their financial destinies. He believed that anyone, regardless of their background or financial expertise, could learn the basics of investing and achieve financial independence. He challenged the notion that investing was a game reserved for Wall Street insiders or financial wizards, arguing that common sense, diligence, and a willingness to learn were far more valuable than any fancy degree or complex financial model. He encouraged people to view investing not as a get-rich-quick scheme, but as a path to building long-term wealth and achieving their financial dreams. Lynch's message resonated with millions of people who had previously felt intimidated or excluded by the world of finance. He demystified investing, making it accessible and understandable to the average person. He showed people that they didn't need to be financial experts to succeed in the market. They just needed to be willing to learn, do their homework, and invest in companies they understood. His legacy extends far beyond the impressive returns he generated for Fidelity Magellan's investors. He inspired a generation of investors to take control of their financial futures, to believe in their ability to learn and grow, and to embrace the power of long-term investing. He showed us that the stock market wasn't a rigged game, but rather a powerful engine for wealth creation, accessible to anyone willing to put in the effort. The perils of PE ratios. Don't be misled by a single number. Peter Lynch, despite being a master of analyzing companies, cautioned against relying too heavily on any single metric, particularly the popular price-to-earnings or PE ratio. While the PE ratio, which compares a company's stock price to its earnings per share, can be a useful valuation tool, Lynch warned that it could be misleading if taken out of context or used in isolation. He emphasized that the PE ratio was just a snapshot in time, representing a company's current valuation relative to its past earnings. It didn't account for future growth prospects, industry trends, or a company's competitive position, all factors that could significantly impact its future earnings potential and consequently, its stock price. Lynch argued that blindly chasing low PE stocks could lead investors into value traps. Companies whose low valuations were a reflection of their deteriorating fundamentals rather than an undervalued opportunity. He believed that it was crucial to understand the story behind a company's PE ratio, considering factors such as its growth rate, profitability, debt levels, and management quality. He encouraged investors to compare a company's PE ratio to its historical average, its industry peers, and the overall market to gain a more comprehensive understanding of its valuation. He stressed that the PE ratio was just one piece of the puzzle and should be considered alongside other financial metrics, qualitative factors, and a thorough understanding of the company's business model and competitive landscape. Beware the whisper numbers. Don't get caught up in the hype. Peter Lynch, a staunch advocate for independent thinking, cautioned investors against getting caught up in the hype and speculation that often surrounded Wall Street's whisper numbers. These unofficial earnings estimates, whispered among analysts and traders, often created unrealistic expectations and could lead to wild swings in stock prices, both positive and negative. Lynch believed that the whisper numbers were often more about generating buzz and trading activity than reflecting a company's true earnings potential. He argued that these unofficial estimates were often based on speculation, rumor, and incomplete information, making them unreliable indicators of a company's actual performance. He encouraged investors to focus on a company's long-term fundamentals rather than getting sidetracked by short-term fluctuations driven by speculation and rumor. He believed that by focusing on factors such as revenue growth, profitability, market share, and competitive positioning, investors could make more informed decisions that were less susceptible to the whims of market sentiment. Lynch also stressed the importance of doing your own research and not blindly following the herd. He believed that the best investors were those who could cut through the noise, form their own opinions, and make independent decisions based on their own analysis. For Lynch, tuning out the whisper numbers and focusing on the fundamentals was essential for long-term investment success. Short-term thinking, the enemy of long-term success. Peter Lynch, a champion of long-term investing, believed that short-term thinking was one of the biggest obstacles to building lasting wealth in the stock market. He argued that the constant bombardment of financial news, the pressure to generate quick returns, and the fear of missing out often led investors to make impulsive decisions that worked against their long-term interests. He encouraged investors to adopt a long-term perspective, viewing their investments as ownership stakes in businesses rather than trading chips to be bought and sold on a whim. He believed that by focusing on a company's long-term growth potential, its competitive advantages, and the strength of its management team, investors could ride out the market's inevitable ups and downs and achieve their financial goals. Lynch stressed the importance of tuning out the noise and distractions that could lead to short-term thinking. He advised investors to ignore the daily gyrations of the market, the constant barrage of news headlines, and the often conflicting opinions of market pundits. He believed that by staying focused on their investment plan and the fundamentals of the companies they owned, investors could avoid making rash decisions driven by fear or greed. He encouraged investors to be patient, recognizing that the best investments often took time to play out. He believed that by resisting the urge to chase quick profits or time the market, investors could allow their investments to compound over time, harnessing the power of compounding to build significant wealth over the long term. Section 4. Emotional roller coaster, keeping your cool when the market heats up. The stock market, with its unpredictable swings and often irrational behavior, can be an emotional roller coaster. Peter Lynch, known for his calm demeanor and rational approach to investing, understood the importance of keeping your cool when the market heated up, whether in the throes of a bull market or the depths of a bear market. He warned against letting fear and greed dictate your investment decisions. He believed that fear could lead to selling at the worst possible time, locking in losses and missing out on potential rebounds. Conversely, greed could lead to buying at inflated prices, chasing returns, and exposing yourself to greater risk. Lynch advocated for a disciplined approach, sticking to your investment plan and your predetermined selling criteria, regardless of the market's mood swings. He believed that by having a plan and sticking to it, investors could avoid making emotional decisions that could derail their long-term goals. He encouraged investors to focus on what they could control, their own research, their risk tolerance, and their investment timeline, rather than worrying about factors outside their control, such as market sentiment or economic forecasts. He believed that by staying focused on the fundamentals and tuning out the noise, investors could navigate the market's emotional roller coaster with greater clarity and composure. Section 5. Following the crowd, the danger of herd mentality in investing. Peter Lynch, a champion of independent thinking, cautioned against the dangers of following the crowd in the stock market. He believed that the herd mentality, the tendency for investors to blindly follow the actions of others, often led to irrational decisions and subpar returns. He argued that the crowd was often wrong, buying at the peak of market bubbles and selling at the depths of market crashes, driven by fear and greed rather than logic and analysis. He believed that the best investors were those who could think for themselves, conduct their own research, and make independent decisions based on their own convictions. Lynch encouraged investors to be contrarian, to look for opportunities where others were fearful, and to be cautious when others were greedy. He believed that the best time to buy was often when the market was down and sentiment was negative, as this often presented opportunities to purchase undervalued companies with strong long-term potential. He stressed the importance of having a well-defined investment thesis, a clear understanding of why you were investing in a particular company or sector. He believed that by having a well-reasoned investment thesis, investors would be less likely to be swayed by the whims of the crowd and more likely to make sound decisions based on their own analysis and convictions. Section 6. Ignoring your circle of competence. Stick to what you know. Peter Lynch's famous advice to invest in what you know wasn't just a catchy phrase. It was a fundamental principle of his investment philosophy. He believed that investors were more likely to be successful if they stuck to their circle of competence, investing in companies and industries they understood. He argued that this familiarity gave investors an edge, allowing them to identify trends, assess risks, and evaluate opportunities with greater clarity and confidence. He believed that when investors strayed outside their circle of competence, they were more likely to make mistakes, misjudge risks, and fall prey to their own biases. Lynch encouraged investors to leverage their own experiences, interests, and observations to identify potential investment ideas. He believed that the best investment ideas often came from our everyday lives, from the products and services we used, the companies we admired, and the trends we observed in our communities. He stressed the importance of doing your homework, even within your circle of competence. He believed that understanding a company's business model, its competitive landscape, its financial health, and its growth prospects was essential for making informed investment decisions. For Lynch, sticking to your circle of competence wasn't about limiting your investment universe. It was about playing to your strengths and increasing your chances of success. Section 7. Overconfidence, humility as an investor's best friend. Peter Lynch, despite his extraordinary track record, remained remarkably humble throughout his career. He understood that even the most skilled investors made mistakes, and that the market had a way of humbling those who became overconfident. He believed that humility was an essential quality for any investor, a safeguard against complacency and a catalyst for continuous learning. He cautioned against letting past successes cloud your judgment or lead to overconfidence. He believed that the market was constantly evolving, presenting new challenges and opportunities, and that those who rested on their laurels were likely to be left behind. He encouraged investors to approach each investment decision with a healthy dose of skepticism, questioning their assumptions, and seeking out diverse perspectives. Lynch also stressed the importance of learning from your mistakes. He believed that setbacks were inevitable in investing, but that those who learned from their mistakes, acknowledged their biases, and adapted their approach were more likely to achieve long-term success. He encouraged investors to view mistakes not as failures, but as valuable learning opportunities. He believed that humility fostered a mindset of continuous learning, encouraging investors to stay curious, to seek out new information, and to refine their investment process over time. He believed that the best investors were those who were always striving to learn and grow, recognizing that the market was constantly evolving and that there was always more to learn. Section 8. Paralysis by analysis. Sometimes you just need to take the plunge. Peter Lynch, while a proponent of thorough research, also recognized the dangers of paralysis by analysis, the tendency to overthink investment decisions to the point of inaction. He believed that while research was essential, there comes a time when you need to trust your instincts, make a decision, and take action. He argued that spending too much time analyzing every minute detail could lead to missed opportunities, as the market often moved faster than investors could process all the available information. He believed that while it was important to be thorough, it was also crucial to be decisive, recognizing that sometimes imperfect action was better than no action at all. Lynch encouraged investors to set clear investment criteria, defining what they were looking for in a company and what factors would trigger a buy or sell decision. He believed that having these criteria in place would streamline the decision-making process, making it easier to pull the trigger when the right opportunity arose. He also stressed the importance of taking a long-term perspective, recognizing that not every investment would be an immediate home run. He believed that by focusing on the long-term potential of their investments, investors could be more patient, riding out short-term fluctuations and allowing their investment thesis to play out over time. For Lynch, finding the right balance between research and action was key to successful investing. Section 9. Neglecting to reassess, the importance of staying flexible and adapting. Peter Lynch, despite his commitment to long-term investing, was not a buy-and-hold forever kind of investor. He believed in the importance of regularly reassessing your investment thesis, ensuring that your original reasons for buying a stock remained valid, and that the company was still on track to achieve its growth objectives. He understood that the market was constantly evolving, presenting new challenges and opportunities that could impact even the most promising companies. He encouraged investors to stay informed about the companies they owned, monitoring their financial performance, competitive landscape, and industry trends. Lynch advocated for a flexible approach, recognizing that sometimes the best course of action was to sell a stock, even if it meant admitting a mistake or deviating from your original plan. He believed that holding onto a stock that was no longer meeting your investment criteria or whose story had fundamentally changed was a recipe for underperformance. He encouraged investors to ask themselves a series of questions when reassessing their holdings. Is the company's competitive position still strong? Are its growth prospects still intact? Is management executing on its strategy? Has the company's valuation become stretched? Are there better investment opportunities available? By regularly reassessing their investments and being willing to adapt to changing circumstances, investors could improve their chances of staying ahead of the curve and achieving long-term success. Section 10. Timing the market, a fool's errand, even for the experienced. Peter Lynch, despite his decades of experience and remarkable track record, believed that trying to time the market was a fool's errand, even for the most seasoned investors. He argued that the market was inherently unpredictable and that trying to predict its short-term movements was a losing game. He believed that investors who tried to time the market often ended up buying high and selling low, eroding their returns and missing out on the market's long-term upward trajectory. He encouraged investors to focus on what they could control, their investment strategy, their risk tolerance, and their time horizon, rather than trying to predict the unpredictable. Lynch advocated for a disciplined, long-term approach, investing consistently over time, regardless of market fluctuations. He believed that by investing regularly, investors could benefit from dollar-cost averaging, buying more shares when prices were low and fewer shares when prices were high, ultimately reducing their average cost per share. He stressed the importance of patience, recognizing that the market would inevitably experience periods of volatility, but that over the long term, the power of compounding would work its magic. He believed that by staying invested, riding out the market's ups and downs, and focusing on the long-term growth potential of their investments, investors could achieve their financial goals. Section 11. Ignoring valuation, price matters, even for great companies. Peter Lynch, while a firm believer in investing in great companies, also understood the importance of valuation. He recognized that even the best companies could be bad investments if purchased at inflated prices. He believed that price matters, and that paying too much for a stock, even a great one, could significantly erode your returns. He encouraged investors to view a stock purchase as buying a piece of a business, not just a ticker symbol on a screen. He believed that just as you wouldn't overpay for a car or a house, you shouldn't overpay for a stock. He stressed the importance of understanding a company's intrinsic value, its worth based on its assets, earnings, and growth prospects, and comparing that value to its current market price. Lynch advocated for a margin of safety, buying stocks at a discount to their intrinsic value to provide a cushion against potential losses and enhance potential returns. He believed that by paying a fair price for a stock, investors were positioning themselves for long-term success, even if the market took its time to recognize the company's true worth. He encouraged investors to use a variety of valuation metrics, such as price-to-earnings ratios, price-to-sales ratios, and dividend yields, to assess a company's relative value compared to its peers and its own historical averages. He stressed that no single metric was perfect and that it was essential to consider a company's valuation from multiple angles, taking into account its industry, its growth prospects, and its risk profile. Section 12. Overpaying for growth. Don't let exuberance cloud your judgment. Peter Lynch, despite his fondness for fast-growing companies, cautioned against overpaying for growth. He understood that investors often got caught up in the excitement surrounding high-growth companies bidding up their stock prices to unsustainable levels. He believed that while growth was an important driver of returns, it was crucial to pay a reasonable price for that growth. He warned against falling into the trap of extrapolating a company's past growth rate indefinitely into the future. He believed that even the fastest-growing companies eventually matured, their growth rates slowed, and their valuations adjusted accordingly. He encouraged investors to temper their enthusiasm for high-growth companies with a healthy dose of realism and a keen eye on valuation. Lynch advocated for focusing on a company's sustainable growth rate, the rate at which it could reasonably be expected to grow its earnings over the long term, rather than its recent growth spurt. He believed that by focusing on sustainable growth, investors could avoid overpaying for companies whose high-growth days were numbered. He encouraged investors to consider a company's competitive advantages, its management team, and its industry dynamics when assessing its long-term growth potential. He believed that companies with durable competitive advantages, experienced management teams, and favorable industry tailwinds were more likely to sustain their growth rates and justify premium valuations. Section 13. Falling in love with your stocks. Objectivity is key to sound decisions. Peter Lynch, a master of dispassionate analysis, cautioned against falling in love with your stocks. He understood that emotional attachment to a company or its story could cloud your judgment, leading to biased decision-making and potentially costly mistakes. He believed that objectivity was paramount in investing, allowing you to make rational decisions based on facts and analysis rather than sentimentality or wishful thinking. He encouraged investors to view their investments as businesses, not love affairs. By maintaining an objective perspective, investors could make clearer-headed decisions about when to buy, hold, or sell, even if it meant parting ways with a company they had grown fond of. Lynch advocated for establishing clear selling criteria before you even purchased a stock, defining the conditions under which you would exit your position. Having these criteria in place would make it easier to make unemotional decisions when the time came, whether to take profits, cut losses, or rebalance your portfolio. He encouraged investors to regularly reassess their holdings, asking themselves if they would buy the stock today at its current price, given their current knowledge and the company's current prospects. If the answer was no, it might be time to sell, regardless of their emotional attachment to the company or its story. Peter Lynch, despite his remarkable track record, wasn't immune to making investment mistakes. However, he believed that the key to long-term success wasn't avoiding mistakes altogether, but rather learning from them and using those lessons to improve your investment process. He viewed setbacks not as failures, but as valuable learning opportunities. He encouraged investors to analyze their mistakes, understanding what went wrong, why they made the decisions they did, and how they could avoid repeating those mistakes in the future. He believed that by honestly assessing their mistakes, investors could identify their biases, refine their investment approach, and become more disciplined and discerning decision-makers. Lynch also stressed the importance of not letting fear of making mistakes paralyze you into inaction. The fear of failure could prevent investors from taking calculated risks, exploring new opportunities, and ultimately achieving their full potential. He encouraged investors to embrace mistakes as an inevitable part of the learning process, using them as stepping stones on the path to investment success. He believed that the best investors were those who were constantly learning and evolving, adapting their approach based on their experiences, both good and bad. He encouraged investors to view investing as a lifelong journey of discovery, filled with both triumphs and setbacks, and to embrace the learning process as an essential part of the journey. The empowering path of common sense investing. Peter Lynch's philosophy, rooted in common sense and diligence, empowers millions to control their financial destinies. He demystified investing, stripping away jargon and complexity. Investing isn't luck, it's a disciplined pursuit of knowledge. Lynch's approach resonates with everyone, from professionals to beginners. You don't need a fancy degree, just common sense and discipline. Look around, observe, and identify investment opportunities in daily life. Be your own analyst, understand businesses deeply. Lynch's legacy inspires investors to trust their instincts and build wealth gradually. Section 2. Unlocking your potential for financial success. Peter Lynch's investment philosophy wasn't just about picking stocks, it was about unlocking your potential for financial success. He believed that anyone, regardless of their starting point, could achieve financial independence if they were willing to put in the time, effort, and discipline. He challenged the notion that investing was a zero-sum game, where one person's gain was another person's loss. Instead, he envisioned a world where everyone could participate in the growth of the economy and share in the rewards of capitalism. He encouraged individuals to take ownership of their financial futures, to break free from the shackles of debt, and to build a solid foundation for themselves and their families. He taught us that investing wasn't just about accumulating wealth, it was about achieving financial security, peace of mind, and the freedom to pursue your passions without being constrained by financial limitations. Lynch's message was one of empowerment, encouraging individuals to take control of their financial destinies and to believe in their ability to create a better future for themselves and their loved ones. He taught us that investing wasn't a spectator sport, but rather an active endeavor that required engagement, education, and a commitment to continuous learning. He believed that the greatest investment you could make was in yourself, in your education, in your skills, and in your ability to adapt and thrive in an ever-changing world. He encouraged individuals to be lifelong learners, to embrace new challenges, and to never stop growing, both personally and financially. Section 3. Building a solid foundation for generations to come. Peter Lynch's investment philosophy wasn't just about achieving individual financial success, it was about building a solid foundation for future generations. He believed that by teaching our children about investing, about the power of compounding, and about the importance of financial responsibility, we could empower them to create a brighter future for themselves and for the world. He encouraged parents to involve their children in their investment decisions, to explain the basics of the stock market, and to teach them about the companies they were investing in. He believed that by making investing relatable and engaging, we could spark a lifelong interest in finance and empower our children to make sound financial decisions throughout their lives. Lynch's emphasis on long-term investing, on patience, and on the importance of ignoring short-term market fluctuations provided a valuable framework for building generational wealth. He taught us that by investing consistently, by riding out the market's inevitable ups and downs, and by focusing on the long game, we could create a legacy of financial security and opportunity for our children and grandchildren. He believed that the greatest gift we could give our children wasn't just money, but rather the knowledge, skills, and values they needed to manage their finances wisely, to make sound investment decisions, and to build a brighter future for themselves and for generations to come. Section 4. Embracing the journey to financial independence. Peter Lynch's investment journey wasn't without its challenges and setbacks, but he embraced the journey, learning from his mistakes, adapting to changing market conditions, and never losing sight of his long-term goals. He taught us that investing wasn't a destination, but rather a continuous process of learning, adapting, and growing. He encouraged individuals to view investing not as a chore or a burden, but rather as an exciting adventure, an opportunity to explore the world of business, to learn about new industries, and to participate in the growth of innovative companies. He believed that by approaching investing with curiosity and enthusiasm, we could make the journey just as rewarding as the destination. Lynch's message was one of perseverance, encouraging individuals to stay the course, to ride out the market's inevitable ups and downs, and to never give up on their financial dreams. He taught us that investing wasn't a sprint, but rather a marathon, and that success came not from timing the market, but rather from time in the market. He believed that the most important quality for any investor was not intelligence or expertise, but rather grit, the determination to succeed, to learn from your mistakes, and to keep moving forward, one step at a time, towards your financial goals. Section 5. Cultivating patience and discipline in the pursuit of wealth. Peter Lynch, a master of long-term investing, understood the importance of patience and discipline in the pursuit of wealth. He recognized that the market could be irrational in the short term, driven by fear, greed, and speculation, but he believed that over the long term, fundamentals would prevail and the best companies would be rewarded. He encouraged investors to resist the temptation to chase quick profits or to time the market, arguing that these strategies often led to more mistakes and lower returns. He believed that the best approach was to identify great companies with solid fundamentals and hold on to them for the long haul, allowing the power of compounding to work its magic. Lynch stressed the importance of developing a sound investment plan and sticking to it, regardless of market fluctuations or the latest investment fads. He believed that having a plan in place would help investors stay focused on their long-term goals, avoid emotional decision-making, and ride out the market's inevitable ups and downs. He encouraged investors to view their investments as ownership stakes in businesses, not just pieces of paper to be traded. He believed that by understanding the businesses they owned and by taking a long-term perspective, investors could make more informed decisions about when to buy, hold, or sell, and they would be less likely to be swayed by short-term market noise. Section 6. Staying the course, weathering the storms and reaping the rewards. Peter Lynch's investment journey wasn't always smooth sailing. He experienced his share of market downturns, economic recessions, and periods of heightened volatility. But through it all, he remained steadfast in his convictions, sticking to his investment principles and never losing sight of his long-term goals. He taught us that weathering the storms was an inevitable part of the investment journey, but that by staying the course, we could emerge from those challenges stronger and more resilient. Lynch encouraged investors to view market downturns not as disasters, but as opportunities to buy great companies at discounted prices. He believed that the best time to invest was often when others were fearful, when the headlines were bleak, and when the market was awash in pessimism. He taught us that by being greedy when others were fearful, we could capitalize on market dislocations and enhance our long-term returns. He also stressed the importance of maintaining a long-term perspective, recognizing that the market would inevitably recover from its downturns, and that those who panicked and sold at the bottom would miss out on the rebound. He believed that by staying invested, riding out the storm, and focusing on the long game, we could reap the rewards of the market's inevitable upward trajectory. Lynch's message was one of resilience, encouraging investors to embrace the challenges of the market, to learn from their mistakes, and to never give up on their financial dreams, no matter how turbulent the journey might become. Section 7. The transformative power of long-term investing. Peter Lynch's investment philosophy, centered on the power of compounding, highlighted the transformative potential of long-term investing. He understood that time was an investor's greatest ally, allowing even small sums of money to grow exponentially over time. He believed that by investing consistently, by reinvesting their earnings, and by letting their investments compound over decades, individuals could achieve extraordinary financial outcomes. He encouraged investors to start early, emphasizing that the earlier you begin investing, the more time your money has to grow. He showed how even small, regular contributions to a well-diversified portfolio could accumulate into significant wealth over time, thanks to the magic of compounding. Lynch's message was one of hope and possibility, demonstrating that financial independence wasn't just a dream reserved for the wealthy or the fortunate, but rather an attainable goal for anyone willing to embrace the power of long-term investing. He taught us that by starting early, by investing consistently, and by letting our investments compound over time, we could achieve financial security, build a brighter future for ourselves and our families, and leave a lasting legacy for generations to come. He believed that the greatest gift of long-term investing wasn't just financial wealth, but rather the peace of mind, the freedom, and the opportunity it provided to live life on your own terms, to pursue your passions, and to make a difference in the world. Section 8. Taking ownership of your financial future. Peter Lynch's investment philosophy transcended the realm of stocks and bonds. It was about taking ownership of your financial future. He believed that financial literacy was essential for everyone, regardless of their income, education, or profession. He encouraged individuals to educate themselves about personal finance, to understand the basics of budgeting, saving, and investing, and to make informed decisions about their money. He challenged the notion that financial planning was complicated or intimidating, arguing that anyone could learn the fundamentals and develop sound financial habits. He encouraged individuals to take control of their finances, to create a budget, to track their spending, and to make saving a priority. Lynch's message was one of empowerment, encouraging individuals to break free from financial dependence, to build a solid financial foundation, and to create a brighter future for themselves and their families. He believed that financial security wasn't a privilege but rather a right, and that everyone had the power to achieve it through education, discipline, and a commitment to making sound financial decisions. He encouraged individuals to seek out resources, whether books, articles, workshops, or financial advisors, to enhance their financial literacy, and to develop the skills and knowledge they needed to navigate the complexities of personal finance. He believed that by investing in our financial education, we were investing in our future, empowering ourselves to make informed decisions that would lead to greater financial security and peace of mind. Section 9. Investing in yourself, the greatest investment of all. Peter Lynch, while a legend in the world of investing, believed that the greatest investment you could ever make was in yourself. He recognized that your earning potential, your skills, your knowledge, and your ability to adapt and thrive in an ever-changing world were your most valuable assets. He encouraged individuals to invest in their education, to pursue their passions, to develop new skills, and to never stop learning and growing. He believed that by investing in ourselves, we were not only enhancing our earning potential, but also enriching our lives, expanding our horizons, and creating a more fulfilling and meaningful future. Lynch's message resonated with people from all walks of life, reminding us that our most valuable asset wasn't our money, but rather our minds, our talents, and our potential. He encouraged us to be lifelong learners, to embrace new challenges, to step outside our comfort zones, and to never stop striving for self-improvement. He believed that by investing in ourselves, we were not only investing in our own future, but also in the future of our communities, our society, and our world. He envisioned a world where everyone had the opportunity to reach their full potential, to pursue their passions, and to make a meaningful contribution to the world around them. Section 10. Leaving a legacy of financial wisdom. Peter Lynch's legacy extends far beyond finance. He was a teacher, mentor, and inspiration to millions. He believed in education and empowering individuals. Lynch's legacy is about common sense, hard work, and excellence. His investment philosophy continues to inspire investors